let's just get the macro set up. Steve, if you don't mind, if we can kind of characterize what we saw in the jobs report. Obviously, an undershoot on job creation for last month, as well as these severe downward revisions. Unemployment rate sort of leaks a little bit higher, and it really did change the bond market's assessment of what's to come for the Fed.
I think all that's right, and it also probably changing the Fed's assessment of what's to come for the Fed. I think we had Raphael Bostic on. He said, look, this shows there's more weakness out there than we thought. And I kind of asked him that question. I said, I wish that I knew what I knew when I had the meeting last week. And he said, well, I don't know if it would have changed it, but we would have been thinking a little bit harder. And I think the big story here, I don't know if we have this full screen available, Mike, but it's the 91% probability of a rate cut in September.
Yeah.
And we went into this meeting with below 50%. Look, we didn't have this data. Now, you might have intuited it. Maybe this tells you a little bit more about y'all should be trading on the soft data, because the soft data told us that tariffs had caused businesses to hold back on capex and on hiring. It also told us that there was going to be price pressure. We got that in the PCE numbers this week. So you have all of the things economists told you that were going to happen. They just didn't happen in stock market trading time. Right? It's all been over this period of time. I don't know how you guys would have made a trade on this, but all of this has come to pass, and there could be more that might come to pass.
Yeah, in fact, let's get right to that. Jim, obviously the setup matters for all these things, right? We had this really calm rally into the end of July, and I think in part it was based on a lot of things, but it was partly based on this premise that the economy was going to remain resilient so that we can withstand a wait-and-see Fed, and we're not begging for rate cuts. Does this change the equation? Look, we're due for probably some give back in August anyway, but how would you view it?
I think the most important thing of what you just said is we were probably due for some give back in August. And I've been saying that for a couple of weeks. I mean, this to me seems like an echo of last year. It's almost the same thing, right? On a Wednesday, the Fed didn't cut. On that Friday, you got a weak labor report, and everybody freaked out. And it was almost laughable at the time. I mean, Steve, I don't know if you remember this, but that weekend, people were calling for an emergency rate cut. I mean, not sane people, but some people.
I'm usually not laughing when that happens. But
that was laughable. Right. And look, the point that I'm driving at here is I think we would all agree the economy is and has been quite resilient. I think we would all agree it's been one heck of a rally. And I said this, I think, on Wednesday, that there isn't a wall of worry to climb right now. Well, guess what? We're going to build a new wall of worry, and it'll be perhaps some indications or some fears of stagflation, right? PCE core a little higher than we'd like. The labor report a little weaker. Let me give the executive summary. Things are going to be just fine. If the Fed cuts in September, I mean, I don't think they really need to, but they probably should as a prophylactic. We had 3% GDP. We're getting uncertainty to decline meaningfully. If the tariffs are at 16%, that's less than feared. All right, take the good. Take the glass as half full. It's less than feared. Companies know what to do. They can move forward. Well, ooh, I got a guffaw from Steve.
Well, only because whatever we thought, like we had a moment of peak uncertainty in April. We got to a moment of peak perceived uncertainty based on, hey, we're going to have this settled around 15% pretty soon. And then things changed, didn't they, last night?
Okay, you mean on the tariff rates?
Yeah. Yeah, on tariff stuff.
Okay, sure. But, I mean, let's face it. This is a president who likes to create drama. There is not going to be a calm day or a calm moment that lasts longer a day in this administration. There just isn't. So, yes, okay, the uncertainty raised a little bit last night, but the trajectory, to me anyway, is clearly down. You've got profits growing. You've got a strong and stable banking system. Not, this perception that the labor report was weak, and since Steve guffawed at me, I feel like I got to go at him now. Look, we have lower working age population growth, right, because of the implications of deporting people. 75,000 is kind of the new 150, is what I would say. Like, this is a stable labor market. The weekly jobless claims certainly don't give me any reason to fear.
Look, I'm a little chastened from the first go-round with the April 2nd tariffs. It was true that if you ignored that, you made more money than if you basically sold it, right? So I want to be careful here. But what I heard you saying, Jim, is everything's okay if I ignore all the bad news. That's sort of what you're saying. If
it's kind of easy to ignore the bad news.
Okay, well, let me tell you.
I mean,
if I ignore the potential,
tell me the bad news.
If I ignore the potential impact of tariffs on hiring and on capital spending, and if I ignore the potential impact of that on inflation, then everything's going to be just great.
I love that.
Now, the president has erected a tariff curtain around this country. Last night was a big deal, right? He put out that list. It is going to be an average of 15%, 5 times what it was. Now, go ahead, folks at home. Trade against me. I hope you're right. I was wrong last time. But by the way, wrong on the issue, by the way, of those huge reciprocal tariffs. He ended up backing off of that, which is where the excitement came from. But I just don't know why you don't have some caution given the magnitude of the change.
And I just want to say really quickly, I have lightened up in the last 2 weeks. I think everybody knows that, but I've done that
at a very high level, right?
Because of seasonality, not because I'm worried about.
So
well, go ahead. I don't want to talk over everybody.
Just to kind of widen it out a little bit in terms of where the market was and where we are. We're pulling back. We're at levels in the S&P from about a couple of weeks ago.
Right.
If I wanted to build a little bit of a bear case for even not because of the specific tariff announcement, you would say, look, we got above 22 times earnings again. Stocks haven't traded all that great off of pretty good earnings numbers. Volatility got a little bit too low. People got a little bit too complacent. And, it's probably just smart to expect a little bit of a spillback. Look, the dollar's rallying. The dollar down was part of the story. Now, you have offsets to that.
There's
right?
No doubt.
Because now we're going to, the rate sensitive part of the economy maybe is going to get a little bit of life if we get a rate cut and bonds rallying. But, how would you as an investor take this from the spectrum of, hey, this is just a blip to we got to hunker down?
Yeah, no, I mean, listen, the VIX has been quiet, right? It's up 20% today. I mean, it's been hovering around 15, so we've been very, very calm waters. Earnings have been very solid, 81% beat rate. 2/3 of the S&P is obviously reported to this point. We've heard from the mega cap players, which obviously have been very positive. But yeah, the RSI is right in overbought territory. We're kind of in that 69, 70 range for both the S&P and the NASDAQ. And tactically, I think what Jimmy mentioned too, I think is critical from a seasonality perspective. We're in the dog days of summer. August into September typically aren't great times for the market, but I do see it as an opportunity given what we've seen from an earnings perspective. And I think that's really what's fortifying more for me the bull case into year end.
Yeah. Bill, definitely jump in, but I also was going to mention, we're seeing this in the headline indexes right now. We've kind of been consolidating under the surface for a little while here. I mean, the equal weight S&P is like 4% off its high. It's just reached its high like Monday or something. So, it's not as if this completely came out of the blue.
Yeah, I mean, the futures hit an overnight high on the Meta and Microsoft reports. And so the chart on the weekly chart is going to look pretty ugly. Big outside bearish reversal. Now, I think there's going to be a little bit more downside, but it's really going to be a stock picker's market. Going back to the Fed, though, I looked at this meeting in July. It was, Trump has been coming after Fed Chair Powell. Obviously, he wants him to cut rates. I think the administration knows there's going to be a little bit of a slowing period as these tariffs hit. I think it's going to pass through fairly quickly. It's going to be Q3. Maybe it drags into Q4. We obviously had the bounce back in GDP for Q2. But I think when you really take a step back, this July meeting, I put a note out to clients early on Wednesday ahead of that saying this is home court advantage for Powell. This was his opportunity to really kind of put his foot down and price out the cuts in September because he was almost pretty much humiliated in many ways during that. So in the aftermath, we talked about it yesterday on the show, the aftermath, those cuts got priced out. Now we're seeing this jobs data, it's pricing those cuts back in. You have 2 cuts with a 60% probability this year, 2 25 basis point cuts. So, is that enough to stop this bleed? I think there could be a little bit more of force here in days to come or through the end of next week. There's going to be more data to come. But the whole point is, if it was Powell's opportunity to put his foot down last meeting or this week, he has Jackson Hole coming up in August, and Jackson Hole can really be the time to communicate transitions in policy. So I think that's really what the setup is here, and we're going to hear a lot about that in August.